Hello, my name is Graham Bibby, Chief Investment Officer, and today I'm joined by Mike Davis, Founding Partner at Causeway Asset Management. Mike, could you tell us a little bit about Causeway and the team and the history of what Causeway's been doing?
Certainly, Graham, and thanks for the opportunity to speak with you this morning and ultimately to your investors. Causeway was founded by myself and my business partner Tim Martin and has origins going back to 2003, so around 20 years ago. And during that time, we've been participating in what is now described as private debt markets across both funds and on balance sheet for various investors that we've worked with, and we've managed around $1.6 billion of assets across private debt during that time. The current fund that we offer and the fund that we've been talking with you about and we'll be talking about today is a senior secured lending strategy to what we describe as the lower mid-market, or some people will use the term SME for that. And that particular strategy that we've been running for the past 4 years has achieved a net return for our investors of around 10.28% per annum during that time. The team we currently have in place is a team of 5 senior investment professionals. We have an average experience across that team of around 30 years in credit markets, so we have seen a number of cycles. We also have supporting that team, we have an independent investment and advisory committee, as well as we use external fund administrators, custodians, and legal advisors for our compliance functions. So that aspect of it is very much well supported by a broader group. And since Causeway's inception 20 years ago, and given the experience that the overall team has had, you can probably imagine we've seen many credit cycles during that time, perhaps most notably managing a fund and debt portfolios through the 2008-2009 global financial crisis. Graham, your microphone's off.
Thank you. So you've talked a little bit about how the asset class is addressed by Causeway. What do you find attractive at the moment about it?
Yeah, that's a good question, because the private debt asset class has become what we describe more often now as as a fairly broad church, in that there are, although it appears to be a relatively new asset class for investors to access over the past 5 to 7 years, it's really an asset class that has existed for many, many years, and it covers things such as property-backed private debt, corporate private debt, and asset-backed private debt. So there's a broad coverage across the sector. What Causeway does, and what we have done for the past 20 years, is we've focused on debt to the corporate loan sector. So to what we describe, as I said earlier, the lower mid-market, or some call it the SME sector. And we in the main, what we operate as is a senior secured lender to that sector, which is important because there's many different exposures that you can take across those different categories of debt that I've described. And the reason we focus on this sector is that we believe it achieves, and has done across the cycles that we've worked in it, you achieve very attractive risk-adjusted returns from what is, in our view, a less competitive sector for borrowers, and I'll describe that in a minute. And those returns can be somewhat equity-like in terms of the levels that they reach. But importantly, what you're doing is you're sitting at the top of the capital structure in terms of the balance sheet. So you are the most, secured investor, if you like. This opportunity has become available over the past really 15 to 20 years, and has grown, as I say, in Australia in the last 5 to 7, mainly because of the bank regulatory environment and banks backing off from lending to this part of the market where there's not a significant amount of property collateral available to them. And that's created opportunities for non-bank participants like us in the marketplace. And I think just one other important point that that I think has created the opportunity in the marketplace and the private debt asset class is that we've seen more recently a lot more companies choosing to stay private for longer. In other words, they're not going to the the listed equity markets as quickly as they used to. And what that's tended to do now is created the opportunity for alternate lenders like us to get in and provide debt to those kinds of borrowers.
That's really interesting, how the market's evolved, and how do you address that market in terms of your process from end to end, from how you originate and structure the portfolio, and then bonds mature, and if there are any problems, how you deal with that during the process?
Yes, no, well, it's certainly an active market. This is not a set and forget kind of investment strategy, I guess I'd hasten to add, Graham. But look, over the course of the 20 years that we've been involved in these markets, we've built up quite a significant network of across the nation of advisors who tend to introduce loans to us. So we don't go looking directly for loans ourselves. We tend to source them from groups such as the mid to large tier accounting firms, from lawyers occasionally, from boutique corporate advisory, debt advisory, and mergers and acquisitions firms, and occasionally from brokers. But over that period of time, we've developed a network of 200 such referral groups across Australia, and it's the age-old comment, I guess, in that you tend to do 80% of your business with 20% of them because they get used to working with you and bringing you what it is they know you're willing to look at. I think also it's important to note that in terms of the way we go about then once we've sourced the loan and determined whether it's something that could fit into our buy boxes, as we term it, or into our investment criteria, it's a very hands-on investment process from there. We will initially seek to have meetings with the management team of the borrower once the loan's introduced to us. We'll prefer to do those meetings on site, or certainly we'll do a site visit at some point during the due diligence process. And what we will also do, apart from our own internal credit analysis, is we may use external experts for reports and valuations on specialty assets or on industry sectors. And we also might get specialist accounting and operational due diligence done by external accounting firms that we work with. But importantly, the in-depth analysis is very much conducted and monitored by our credit team. And that's a team that has been bank trained in years gone by, and our current head of credit has worked in the business with us for 15 years, so he very much knows and dictates or drives the process that we conduct. And importantly, our credit team has also had during their time both workout and restructuring experience. And I mention that because it's important to have that skill set, particularly in this market where businesses, when they do have challenges from time to time, that we're able to work with them to make sure that we can get over those kinds of events. The portfolio is constructed and monitored then by our portfolio managers, and what the portfolio managers are responsible for doing, apart from maintaining the client relationship, is also monitoring quarterly reporting by the client, quarterly financial reporting, an ongoing cash flow analysis of the client's operations, as well as monitoring the loan covenants that we put in place through the structure of the loan, and also monitoring the underlying collateral that is providing security for the loan. And I think the last comment I'd just make to answer your question, Graham, is that we're certainly seeking to achieve diversity across what are defined as the ANZIC industry classifications here in Australia, and we have quite good diversity across a number of those industries. And we're also seeking to achieve diversity across the underlying collateral pools, or the assets that support the underlying loans, be they debtors, inventory, plant and equipment.
Thanks, Mike. And it's a really interesting style and area that you're addressing, particularly with the SME loan sector. Yeah, specifically what makes it attractive now, and like some of the things that we're aware of is that bigger companies have access to bond markets, small companies don't. And historically, the banks were a big part of lending to a lot of small to medium-sized enterprises, but less so now. So the bits that you find attractive, find those at high level, I guess, are some of the reasons. What else do you like about the SME sector?
Yeah, look, I think as you've identified, it's a market that has not, or it appears to be no longer attractive to the larger domestic banks and or the larger domestic or global private debt players. They tend to be looking for larger deal size requirements. So we're typically focusing on debt deals or borrowings in the range of 2.5 million on the low to 25 million on the high. Although it's fair to say our sweet spot at the moment is probably in that $2.5 to $10 million range. And so what that does is that has essentially meant, and you made the comment about the banks, having withdrawn from the space and for the regulatory reasons we talked about earlier, the mid to lower mid market space is typically therefore underfunded in this country. And, it's very much the engine room of employment in Australia. And we've had surveys done, in fact, prior to launching our current fund 4 years ago. We had a survey done by a group of Eastern partners, and they ascertained that there were probably around 60,000 or more enterprises in this sector that we're looking at. So it's certainly a large sector, and it has a borrowing requirement approaching something near $500 billion. So it's certainly not an insignificant marketplace and opportunity for us to look at. What we also think is attractive about it, as another answer to your question, is that because these are typically mostly private companies, although we do lend to listed companies as well, but typically private companies, the thing that we like about that is that the founders and senior management also tend to have skin in the game, i.e. they own a substantial part of the company, if not all of it, and their interests are very much invested in growing the business and protecting their asset base. So when we come in as a senior secured lender, we feel very comfortable that our interests are very much aligned with them. But I think probably the last comment I'd make about the attractiveness of the sector is that we've been able to achieve regionally diverse exposures right across Australia, across most of the states and territories. We certainly don't just focus on metropolitan placed businesses. We look at regionally placed businesses. And we think that is also attractive because we tend to find that a lot of the larger lenders tend to overlook that. So, we're able to achieve the price targets for our investors from those borrowings that we can on that basis.
Thanks, Mike. So when an investor's looking at this as a new investment, what should they consider as the risks when considering adding private credit or private debt to their portfolio?
Yeah, I think, apart from, I guess, the fundamental risks that you would tell any of your investors about, exposures across asset classes, I think the two key things with private debt and the number of managers that have become available in the marketplace over time, I think the key thing is getting true to label exposure and getting appropriate risk-adjusted returns for that exposure. So, if your private debt manager is telling you they're writing senior secured debt, that's what you want to see you're getting, and that's what you want to see you're getting paid for. There are numerous different descriptions across the debt spectrum that can be applied, but senior secured, as I've said before, is at the top of the capital structure, and you need to be sure that's what you're getting in terms of the underlying exposure. And I think probably the other main comment I would make in terms of the risks investors need to consider, particularly with the growth of the asset class over the last 5 to 7 years, as I've mentioned, is getting an experienced management team, who've managed these kinds of portfolios, through credit cycles. And I think it's important that those management teams have also had hands-on experience in terms of, restructuring and workouts where that might have been necessary.
Again, thanks, Mike. And maybe sort of bringing a little bit more of this to life, what would be a couple of examples of, companies that you've lent to?
Sure, yeah. In fact, interestingly, in this portfolio that we'll be able to give your investors exposure to, we've currently got in excess of 10 loans in that portfolio. So that will give them immediate diversity. These loans, as I mentioned before, we're typically lending from 2.5 up to 25 million, but the current portfolio has loans ranging in size from around 900,000 to around 7 million is the largest loan. That $900,000 loan is a loan that started out at over 2 million and has now amortised over time, and I think it's due to repay in the middle of this year. And what we tend to do is we tend to write loans in that sort of 2 to 3 year up to 5 year maturity. And if we write them for any longer than 3 years, we will actually build in amortisation into that loan. So what that means is the kind of portfolio we run tends to have an average life at the moment running around 2.25 years. I think importantly, to give you more detail on the underlying loans, as I mentioned, we are a senior secured lender, so all of the loans that we have in our portfolio are secured under what's described as a general security agreement or a GSA, and that enables us to get security and recorded security via our documentation over the debtors, the inventory and the plant and equipment of the borrower, which might also include a PPSR registration over that plant and equipment, which is a national register for those underlying assets. And we might also achieve, small mortgages over a property portion of the collateral that we're lending against. So what we're looking to do is to lock up all of the underlying assets of the business as part of the collateral package. Importantly also, given that we lend to a number of private companies, as I touched on before, we're typically looking to get personal guarantees from the owners as well. We do achieve that in most cases. Perhaps to give you a couple of examples of some of the loans that we've got in the portfolio that might just help resonate for some of the investors. I think there's probably just two I would touch on at the moment. One that we have in the portfolio and have had for a couple of years now is a group known as Inside Out. If any of your investors are plant-based milk consumers, these guys have built quite a successful, alternate or plant-based milk production and distribution facility, and they've achieved quite significant national presence with their products over the time that they've borrowed from us. We've got security against their debtors and their inventory and their plant and equipment, and they typically, as their debtors tend to be the likes of Woolworths, Coles, Myer, Harris Farm, those kinds of national distributors of product. So what that means is, and we often talk about this in these kinds of conversations, is that even though we're lending to an unrated borrower, what we find is that security collateral behind that borrower will be debtors, or debt that's owed by highly rated organisations such as a Woolworths or a Coles. So there's a kind of a credit arbitrage involved in there, if you will. Another quick example I'd give you, and this might be a name that some people recognise, is we do lend to a regional airline in far north Queensland known as Skytrans. It's an interesting one for us in that we like the way in which it is set up, and we've got security against its planes and its debtors and a number of its aircraft parts. And what they do is they provide a specialty or a contracted service to both passengers and freight, fly-in, fly-out services to mines, and importantly, they provide services to many of the far-flung remote Indigenous communities in far north Queensland, including, again, freight and passenger services as well as medical and other essential services provisions. So, we like that opportunity as well.
And so for the experience in investing in the fund, what would be the target return that you're targeting? What would be the sort of distributions that investors could expect?
Yeah. Yes, look, we think over a full market cycle, the sorts of net returns after fees that you should be achieving are in that 9% plus return frame. As I mentioned, we've achieved over the past 4 years in excess of 10% net to our investors. We think that that opportunity will continue, and that's the sort of return you should be achieving from senior secured lending to this sector, in our view. The fund that we're talking about with you, of course, is going to have a fixed quarterly distribution, and we'll be targeting a 2% quarterly distribution to investors. Then we would like to think there'll be a catch up at the end of the year to make up that differential to 9% plus.
And for investors applying, how frequently can they apply? This is an open-ended fund.
Yes.
And it has a characteristic of an initial lockup for a period to sort of match to some degree with the underlying liquidity of the loans, and then the redemption terms.
Yeah, so we are typically looking to take investments in on a monthly basis, Graham, so towards the end of the month, and we look at minimum investments of $100,000 for the fund from individual investors. The redemption on the fund will be available after 18 months from the initial investment, and that will be then available on a quarterly basis with 90 days advance notice of that withdrawal. So subject to fund liquidity, we expect that will be the liquidity time frame that investors should expect to work with.
Excellent, thank you. Any final thoughts before we sign off? And I'll also recap for the investors, where to find information as well.
Yeah, look, I think I would just make a closing comment. As I said before, the private debt asset class, is a broad church, and there are a number of opportunities across the various asset buckets. Importantly, we've focused over the last 20 years on lending to the business sector or the corporate sector against their business assets, because we feel that that's if you will, a much less emotional lending, that the underlying assets are not somebody's home or particular property. They are more business assets such as debtors, inventory and plant and equipment, as I talked about, and they tend to be therefore something that you can deal with very commercially with the borrower and achieve the right outcome for the borrower and the right outcome for your investors over the full cycle. So we've certainly seen during our time that in challenging markets, it's been a great place to be, and we would like to think that's going to continue. It's what we've sometimes described, and you've heard me say this, Graham, we call it medieval merchant banking. It's it's what the Medicis did 400 years ago in Italy, and we're just doing the same thing a bit later in the cycle and creating that opportunity for individual investors to be a part of it.
Excellent. Thanks very much, Mike. And for all our sort of investors and clients out there, this will be available alongside some written material on the Partners Private website and the microsite for this specific fund. So you can find all of the information there. And if you have an advisor, speak to your advisor as well. If not, then the Partners Private investor relations team can direct your queries on anything that you've interested in there. Thanks very much, Mike, and thanks to everyone who's joined. Thanks.
Thanks for the opportunity, Graham.
Yeah, bye.
Bye now.